What if I told you the next move in silver isn't starting in New York, it isn't starting in London, and it isn't even starting in futures markets? It's starting with three signals most investors are not watching. The world's largest silver producer is facing sudden instability. Gold-backed crypto is trading at a premium before Western markets even open. And COMEX delivery data is behaving in a way we rarely see this close to expiration. That is not noise. That is structure. Right now, we are witnessing the intersection of supply uncertainty, tight physical markets, shifting central bank reserve strategy, and thin global liquidity. When these forces align, price doesn't drift, it reprices. This is not about hype. This is about how capital moves when risk changes. Welcome to World Finance History, where we break down market structure, not headlines. Let's connect the dots the financial media won't connect for you. When a single country supplies roughly 1/4 of the world's mined silver, and that country suddenly erupts into widespread security disruption, markets stop treating the situation as background noise and start treating it as a potential supply shock. Mexico's outsized role in global silver production is not trivia. It is the structural backbone of the physical market. Recent reporting confirms a major security operation that killed the leader of a powerful cartel and immediately triggered road blockades, airspace disruptions, and flight cancellations across tourist and mining regions. Those events were followed by airlines pausing service and government shelter-in-place warnings, the kind of ground-level disruptions that complicate mine logistics and concentrate operational risk. From a fundamental standpoint, these events should be understood in terms of supply chain fragility rather than instant mine closures. Mines rarely stop producing overnight, but they are highly sensitive to transport links, workforce availability, and security on access roads. When convoys cannot move, concentrate shipments are delayed, and processing and refinery schedules are disrupted, all of which increase effective short-term tightness even if headline production numbers do not immediately decline. Recent examples in Mexico and other jurisdictions show production hits of 20 to 25% at affected sites following security incidents or labor actions, demonstrating how localized disruptions can reverberate materially through monthly supply flows. Layer that operational fragility over an already constrained market, and the sensitivity to uncertainty becomes stark. International supply data shows that Mexico has been the largest single-country supplier of silver in recent years, with industry reports repeatedly flagging Mexican output as central to global balance calculations. Where physical markets are tight, driven by rising industrial demand for green technologies and constrained new mine development, incremental uncertainty around Mexican logistics translates into outsized price leverage because marginal ounces matter more. The risk transmission channel is clear. Security-driven transport and processing delays compress available physical inventory, which forces market participants who need metal for industrial, investment, or delivery purposes to compete in thinner secondary pools or bid up nearby premium instruments. That repricing can show up first in physical premiums and in round-the-clock proxy markets, creating directional pressure on paper prices when primary markets reopen. A disruption anywhere in Mexico is not a local event for silver, it is a global structural signal. Markets move on scarcity, not on narratives. The clearest signals often come from where the metal actually sits, who wants it, and how thinly it can be redeployed. Industry-wide surveys and supply-demand models show repeated annual deficits, and a market that, even with modest increases in mine production, cannot easily replenish near-term draws on physical stocks. That persistent structural deficit is not an opinion, it is the framework analysts at the Silver Institute and Metals Focus have been publishing for the last 2 years. Warehouse and exchange data made that structural tightness tangible. COMEX registered silver inventories saw dramatic single-day draws in early February, pushing total visible stocks under psychologically significant thresholds and reducing the pool of ounces available for immediate delivery. Those withdrawals matter because futures contracts, options, and retail investors ultimately convert paper exposure into physical demand, and when visible inventory is thin, the margin for error shrinks. At the same time, the Shanghai Exchange and other Asian physical centers were pricing material premiums to Western benchmarks. A persistent Asia West premium indicates real, settled physical demand that is willing to pay more to secure metal now rather than wait for financial instruments to catch up. It is a direct signal that the marginal buyer is operating in the physical market, not the paper market. When physical markets lead, paper markets often follow, and they can do so quickly. Speculative positioning added another layer. Commitments of traders' data over recent months showed non-commercial net long exposure in silver contracted to multi-month lows, meaning the classic leverage crowd that often amplifies rallies was not the engine here. Instead, price pressure was driven by physical demand and constrained liquidity, a more durable driver than short-term speculative activity. When speculative longs are light and physical demand is heavy, marginal ounces become disproportionately valuable. For professionals assessing risk, the takeaway is practical. In a market where visible inventories are declining, physical premiums persist, and speculative buffers are thin, even modest logistical or geopolitical disruptions can produce outsized price moves. Focus less on headlines and more on primary source metrics: exchange warehouse flows, Shanghai premiums, and QOT positioning, because those are the variables that determine how quickly paper prices must reconcile with physical reality. When markets are closed, the real-time information flow does not stop, but the instruments that can reflect it do. That is where a token like PAXG Gold becomes more than just a crypto curiosity. It becomes a continuous, round-the-clock proxy for physical gold demand. Unlike traditional spot or futures markets, which operate only during business hours and carry settlement lags, tokens like PAXG trade on crypto exchanges 24 hours a day, 7 days a week, offering uninterrupted price discovery that captures sentiment changes as they happen. Because each PXG token is backed one-to-one by a fine troy ounce of LBMA-accredited physical gold stored in secure vaults, trading activity on these token markets directly reflects traders' willingness to price gold outside of normal market windows. Traditional gold markets pause over weekends and holidays. Futures markets rest between sessions, but tokenized gold markets never sleep. When investors pivot towards safe haven exposure, whether due to geopolitical shocks, macro uncertainty, or supply concerns, tokenized instruments can price that shift immediately, even when traditional venues are closed. A significant weekend premium in PXG is not noise. It signals real willingness to pay more for gold exposure when institutional access is unavailable. Volume surges and price premiums on-chain often tell us that demand for immediate risk hedging is rising faster than delayed open interest adjustments in futures. The mechanics are important to understand. In a standard futures market, price discovery largely happens during open trading hours, and any weekend gap is only acknowledged after the open. With tokenized gold trading around the clock, participants who want exposure when traditional markets are shut must express that demand through available venues, and that can push premiums above the previous spot close. This behavior suggests more than speculative activity. It indicates urgent demand for safe asset exposure when traditional gold markets cannot yet react. Because PAXG is physically backed, these premiums are anchored to real asset demand, not speculative crypto flows. There is also an important structural element involving arbitrage. Under normal conditions, meaningful premiums in PAXG compared to spot gold incentivize arbitrageurs to step in, redeem tokens for physical gold, or hedge across venues, which tends to compress spreads. But when markets are disrupted or sentiment shifts suddenly outside normal trading hours, insufficient liquidity or operational friction may prevent immediate arbitrage, allowing premiums to persist longer. That prolonged premium tells us something about risk perception, not just price mechanics. Tokenized gold is still a relatively new bridge between traditional commodity pricing and digital liquidity, but its growing market cap and trading volumes demonstrate that sophisticated participants increasingly treat it as a real and accessible instrument for hedging and positioning. Weekend premiums in PXG do not just display price anomalies. They reveal where market attention and capital are flowing when the rest of the financial system is closed. When open interest in a futures market like COMEX climbs into unusually high territory just before a contract's delivery window, it tells informed traders something very specific about market positioning. Open interest measures how many futures contracts are outstanding and unsettled, meaning each long position held by a buyer is matched by a seller short on that contract. When that number rises alongside price, it generally signals that new money is flowing in and that participants are building conviction in the emerging trend. Traders use this to gauge sentiment and trend strength. When a front-month contract shows elevated open interest as the delivery period approaches, the implications become more structural than purely momentum-driven. Futures markets are designed for participants to roll positions ahead of expiration, meaning most traders who are not planning to take physical delivery will exit or roll over to a later month well before the delivery window opens. When open interest fails to decline, it suggests that significant capital remains deployed right into the delivery cycle, raising questions about whether those positions are meant for hedging, speculation, or actual delivery intent. In physical delivery contracts like those on COMEX, futures carry the potential for real metal to change hands. Registered warrants and delivery certificates are the mechanism by which futures longs can convert paper exposure into physical delivery. When persistent open interest remains late into delivery, it signals that either longs are unwilling to exit or shorts are unwilling or unable to fully close positions, which can create structural pressure on the market's delivery mechanics. When open interest stays high instead of rolling off, it can result in a compressed inventory situation where deliverable metal becomes scarce relative to the number of claims on it. Even where cash settlement is possible, the psychological and technical pressure can shift risk premiums, draw physical demand into the expiring contract, and alter arbitrage dynamics between physical and paper markets. This tension becomes particularly relevant in tight markets where visible inventories in exchange warehouses have been declining and physical withdrawals have been robust. In that environment, elevated open interest is not just a statistic. It signals that a significant portion of market exposure remains pegged to an expiring delivery timeline, which can force price adjustments and create volatility independent of broader macro fundamentals. For professional traders and institutional allocators, this nuance matters. Rising open interest into delivery highlights structural risk in positioning, not just sentiment. It reflects how capital is committed, how that commitment may unwind, and how pricing may adjust when delivery mechanics are tested under constrained physical conditions, all of which are critical factors in interpreting price discovery beyond simple trend following. Thin liquidity changes the rules of engagement. When a major trading center is offline, price moves no longer reflect a broad consensus. They reflect the behavior of whoever is left to trade. Traders who watch tape know this intuitively, and quantitative models confirm it. Empirical work on futures liquidity shows that market maker behavior and liquidity provision change meaningfully as volatility and participation shift, so price moves in thin sessions are structurally different from those in full participation sessions. The immediate practical implication is straightforward. Gaps and exaggerated swings become more likely. When Shanghai and other Asian hubs close for an extended holiday or emergency, global precious metals depth is materially reduced. Chinese market closures have repeatedly correlated with lower volumes and higher realized volatility in gold and silver on reopening. That reduction in available counterparties means that a relatively modest flow, a weekend premium in a 24-hour venue, a physical buying spree, or a concentrated liquidation, can move price much farther than the same flow would in a thick market. This is not theoretical. Exchange notices and holiday schedules create predictable windows where liquidity evaporates. The Shanghai Futures Exchange and related Chinese venues publish holiday schedules that pause trading for days or even weeks, leaving the West to price risk without Asia's often decisive physical demand component. Experienced practitioners adjust risk parameters ahead of these windows, reducing size, widening stops, and expecting wider spreads, because the market structure simply does not support the same execution quality. The tactical consequence for Monday opens is asymmetric risk. A weekend of geopolitical headlines, delivery cycle stress, or physical premiums can lead to aggressive pre-open pricing in proxy markets. But when the primary physical price discovery center is still offline, that pre-open move meets a thinner institutional book, which can magnify gaps and then produce sharp intraday reversals as liquidity returns and mean reversion trades hit. Smart participants monitor not only headline flows, but also exchange warehouse movements, weekend token premiums, and open interest to infer how fragile the tape may be once the market reopens. The behavioral dynamic also matters. Thin markets breed feedback loops. Price moves attract attention, which draws the few active participants to react faster and often more aggressively, creating a short window where directional conviction becomes self-fulfilling until the broader market returns and pulls the move back. Recognizing that environment is how professionals avoid being right at the wrong time. They size for thinner liquidity, emphasize execution, and treat early session gaps as signals to manage risk rather than invitations to overcommit. If central banks quietly rewired their reserve allocations over the past few years, the market impact is anything but quiet, and the evidence is now visible in official data and institutional reports. Central banks have been net buyers of gold at an unprecedented pace, with reported net buying running into the hundreds of tons per year as sovereign reserve managers sought non-dollar diversification and geopolitical insurance. That is not anecdote. It is the World Gold Council's data showing sustained above historic norm official buying and survey evidence that more central banks are actively managing gold allocations. The arithmetic consequence of that buying becomes structural when you compare balance sheets. Recent compilations of official reserve holdings show that the aggregate value of central bank gold holdings has climbed to a level that, in dollar terms, now exceeds the stock of U.S. Treasuries held by those same institutions, a reversal not seen since the mid-1990s. Several independent market reports documented this shift in 2025, and Reuters chronicled the same dynamic as gold's role in official portfolios expanded. Why does that matter for inflation dynamics? For decades, the dollar's reserve status meant foreign buyers absorbed U.S. fiscal deficits by holding treasuries, effectively allowing the United States to export a portion of its inflation. When reserve managers instead allocate larger shares to gold, a non-yielding hard asset, that absorption mechanism weakens. Less external treasury demand means a larger share of U.S. government financing must be funded domestically or at higher rates, which changes the trajectory of domestic price pressure over time. The IMF's COFR series confirms that the dollar's share of disclosed reserves has trended lower from its peak. The trend is what matters because it signals a multi-year rebalancing of official portfolios. When you combine that trend with persistent central bank gold buying and visible physical premiums in Asia, you get dual pressure: rising safe asset demand supporting gold, and reduced structural demand for treasuries weakening an important channel that historically exported U.S. inflation. For investors and allocators, the takeaway is practical. The reserve shift is not a single-day event, but a compounding structural force that raises the floor under precious metals and changes the policy elasticity of U.S. fiscal expansion. Monitor official reserve statistics, central bank purchase flows, and the changing composition of foreign holdings, because these are the plumbing changes that alter how inflation, interest rates, and safe haven valuations interact over years, not quarters. So here's where we stand. Mexico introduces credible supply risk into a market already running structural deficits. Physical silver demand has been firm, while speculative positioning remains light. Gold-backed tokens are signaling weekend safe haven positioning before institutional desks even log in. COMEX open interest near delivery is statistically abnormal. Global reserve managers are reallocating away from treasuries and toward gold, and liquidity conditions are thin enough to amplify whatever move comes next. None of this guarantees a breakout. None of this guarantees a gap. But together it forms a framework, and frameworks are what serious investors use to navigate volatility. Markets reward preparation, not reaction. They reward verification, not emotion. And they always move before consensus catches up. Watch the data, watch liquidity, watch delivery, watch physical premiums. Because when structure shifts, price eventually follows. This is financial education, not advice. Invest with discipline, think in probabilities, and let logic lead, not noise. World finance history, and I will see you in the next analysis.